This is Nightly Business Report with Sue Herrera and Bill Griffin.
It is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year.
Fed up, the central bank hikes interest rates and lowers its forecast for future increases. But that did not alleviate investor angst. Stocks sink, the Dow closes at a new low. So does the transportation index, and some say that is a red flag. Mega deal, Pfizer and GlaxoSmithKline join forces to create the world's largest seller of over-the-counter medicines. Those stories and much more tonight on Nightly Business Report for Wednesday, December 19th. Good evening, everyone, and welcome. Bill Griffith is off tonight. It felt like a Wall Street revolt. Investors did not react kindly to the Federal Reserve's outlook on interest rates. The central bank today raised rates as expected. It also signaled that it would likely not hike as many times next year as previously thought. But the market wanted more than it got, so volatility set in and stocks took a dive. The Dow Jones Industrial Average dropped 351 points to 23,323. That's a new low for the year. The Nasdaq was down 147 points, or more than 2%, and the S&P 500 fell 39. We have 2 reports tonight. Steve Leisman is covering the Fed's decision from Washington, but we begin with Bob Pisani at the New York Stock Exchange.
Stocks rallied ahead of the big Federal Reserve decision today, but sold off in a rather notable way once the announcement was actually made. Now, the Fed raised interest rates by a quarter point. That was pretty much anticipated by the markets, but the Fed trimmed its rate hike forecast for 2019 from 3 to 2. The markets found that tough to swallow. Investors were hoping for the Fed to signal just 1 rate hike, if any at all, next year, and for the Fed to assure everyone that they were flexible. But why was the sell-off so severe? A lot of this damage is technical now. The Dow closed at a new low for the year, below the March lows, at the same time as the Dow transports also closed at a new low. This is a red flag for those who follow Dow theory, which looks for one of the Dow indicators to confirm a trend in the other. And when both indicators hit new lows, it's considered a negative trend by some technical experts. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Today's Federal Reserve meeting had been called one of the most controversial in recent memory. And as Steve Leisman reports, it lived up to that description.
A negative reaction in markets to the decision by the Federal Reserve to raise interest rates and signal further rates ahead. It seemed like the market wanted the Fed to back off entirely from plans to raise rates next year. Instead, it got only a partial backing off at best. Here's Federal Reserve Chairman Jerome Powell explaining the change from forecasting 3 rate hikes next year to now forecasting 2 quarter-point rate hikes.
Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year. We always emphasize that our policy decisions are not on a preset course and will change if incoming data materially change the outlook.
Here's a look at what the market wanted and what it got. The market had wanted just 1 or no rate hikes forecast for next year. Instead, it got those 2 hikes down from the previously forecast 3. The market wanted some flexibility on the Fed's plans to reduce the balance sheet by $600 billion next year. Fed Chairman Jay Powell said, we're going to go ahead with reducing that balance sheet. Finally, it seemed to want more concern about the economy. Instead, the Fed put a line in the statement saying it's monitoring financial developments, but not necessarily acting on anything yet as far as the market is concerned. Now, there may have been a little bit more dovishness in the Federal Reserve Chairman's statement than maybe the market gave it credit for. Here's him talking about how the data are going to dictate what the Fed does next year.
I think from this point forward, we're going to be letting the data speak to us and inform the outlook and inform our understanding of what would be appropriate policy. So there's a fairly high degree of uncertainty about both the path and the ultimate destination of any further increases.
Maybe one of the biggest disappointments for the market was they wanted the phrase that further gradual increases are needed removed entirely from the statement. Instead, it got a watered down one where the Fed said that some further gradual increases will be needed. So overall, the market wanted a Fed that was completely dovish for next year in the wake of the big market sell-off. Instead, it got one that's kind of sticking to its guns, that there will be additional growth next year, that there'll be low unemployment, and that will all require further rate hikes. For Nightly Business Report, I'm Steve Leisman in Washington.
Joining us now to talk about today's rate hike and what it means for the broader economy and the markets is Mark Zandi, Moody's Analytics Chief Economist, and Brett Ewing, Chief Market Strategist at First Franklin Financial. Gentlemen, welcome. Nice to have you here. Mark, I'm going to start with you, if I will. Given what you know about the economy and as you see the economy, did the Fed chief do the right thing?
Yeah, I think he nailed it. I think he scaled back rate hike expectations for next year from 3 to 2. That seems very consistent with the message the Fed's been sending markets all along. You know, I think markets had very high expectations here, overly high expectations, and were disappointed. But, you know, the reality is the economy is still growing strongly, probably will continue to grow strongly enough next year that unemployment will continue to decline. So I think the Federal Reserve has it exactly right.
So, Brett, you know, I feel like we've been talking about this Fed meeting for some time now, and the market, according to a lot of the analysts that we talked to, had factored in a rate hike here. So why the vehement reaction by the market today?
Well, I think today is going to be a historic day. I think it's a day where the Fed looked down at the market and they said, look, you're grown up now. You need to stay on your own 2 feet, and we're not going to be there for you. And the market really didn't know how to take it. And it'll be interesting the next few weeks on how the market really reacts.
And what do you expect?
I expect that these conditions are really oversold, in my opinion. Mm-hmm. And I do believe that we'll get a little lift going into the end of the year.
Mark, let me turn you to the global economy, because that was mentioned by the Fed chief. If our economy is growing strongly, the global economy in many sectors is struggling, and we still have Brexit to go in the UK, and Italy has its own financial issues. The Fed seems to be looking at that and factoring it all in. Is that appropriate?
Yeah, I think so. I mean, I think the key thing overseas, dead ahead, is Brexit. There's a March 29th, 2019 deadline. And I do think there's going to be a lot of uncertainty, market tumult as we approach that deadline. You know, I suspect the British aren't going to nail this thing down until the last minute. So, you know, if you're thinking out to next year and when the rate hikes will occur, probably won't be at that first March meeting that when you know they normally would raise interest rates. So, you know, I think global conditions matter. Brexit matters a lot. Having said that, you know, the U.S. economy is very relatively insulated from the rest of the world, and we can grow quite strongly even if the rest of the world isn't up to par. And I would expect that in 2019. There's a lot of fiscal stimulus still coming here, increases in government spending. And we're in a virtuous cycle, low unemployment, accelerating wage growth, which begets more spending and hiring and lower unemployment. So, you know, I do think growth next year will be strong enough for at least 2 rate hikes.
But we're also starting to see the impact of the trade war with China specifically. It was mentioned, and we'll get to this a little bit later, by FedEx as one of the issues that they've been dealing with. Is that a danger for this economy?
Yeah, absolutely. I mean, I'm making the assumption that President Trump doesn't escalate the trade war, that he figures out a way to come to a face-saving agreement and the trade war fades away. But if that's not the case, if he escalates the war, then absolutely, positively, the Fed's not going to be able to raise rates next year.
Brett, I'll give you the final word here. What do you do in this market if you're a longer-term investor? If you feel we're oversold, do you anticipate a bounce in this market? Would you be buying at these levels?
I would certainly take a look at some of the equity markets. I really feel there's some interest-sensitive areas within the economy that are just completely oversold. We're seeing some of the mortgage REITs just trading at valuations that I think that we would take a look at them. So.
All right. On that note, gentlemen, thank you. Mark Zandi with Moody's Analytics and Brett Ewing with First Franklin Financial Services. Well, Bob Pisani mentioned the transportation index, and it was driven lower today, in large part because of FedEx, which I just mentioned. We told you about that last night. The company slashed its 2019 outlook, citing an international slowdown, and the CEO, Fred Smith, on the company's earnings call, said the weakness was largely due to politics.
Most of the issues that we're dealing with today are induced by bad political choices. I mean, making a bad decision about a new tax, creating a tremendously difficult situation with Brexit, the immigration crisis in Germany, the mercantilism and state-owned enterprise initiatives in China, the tariffs that the United States put in unilaterally.
FedEx shares finished down today 12% to 162.51. And that also caused the Dow Jones Transport Index to fall more than 3% to 9,147, pushing it into a bear market. Now, the age-old Dow theory suggests that when this index isn't doing well, it could foreshadow a drop in the broader market. Joining us to talk about what might lie ahead on that front is Matt Maley, Managing Director at Miller Tabak. Welcome back, Matt. Nice to see you again.
Great to see you, Sue. Happy holiday.
Yes, you too. Do you adhere to the Dow theory? Do you think that this does portend new lows in some of these markets?
I think it will eventually. The market is getting a little bit washed out, at least on a near-term basis. Maybe not the major capitulation that we've seen at major bottoms, but we should get a little bit of a bounce here. But I do worry about this. Federal Express, I know they kind of blamed it on some political issues, but they must seem to think that they'll be last a little bit longer because they did initiate a fairly a decent-sized cost-cutting program. Also, when you look at the transportation index, it's not just the Federal Express and UPS or some of the other airlines. We also see some weakness in the railroad stocks. And of course, they're very important. They move billions of dollars of goods around our country, and those stocks have been moving down as well. So it kind of tells me that, yes, we are going to see a little bit of slowdown, which is what we usually see when the Fed engages in a tightening program. And, it doesn't mean we'll go into recession, but it should see some lower lows, I think, before, at some point next year.
But it's interesting, is it not? If the economy is doing well, we have unemployment that is expected to still tick to the downside. Companies say that their sales are robust. The things that ship those things that they make, like the railroads, are going down. And oil prices are lower.
Right, and that kind of that kind of tells you that going forward, that even though consumer confidence is good, and that as you mentioned that employment seems to be quite good, some of these things are starting to tell you that this is going to roll over as we move into next year. Again, and that doesn't necessarily mean we're moving to recession, but with the stock market was basically priced in for perfection back in September. We're not getting that anymore, and not only do we no longer have the global growth going on, now it looks like we might have a little weakness in the U.S. as well. And
you say to raise cash if we get a bounce in this market. Where would you put? Would you stay in cash, or does the bond market, as interest rates go up, look a little more attractive?
I think the best way to, yes, raise a little bit of cash. That's always great because if they throw the baby out with the bathwater, it creates some great opportunities. But you also want to look at the stocks that pay a good dividend, but not just a good dividend. Look at stocks or companies that have a history of increasing their dividend every single year. And if you don't need the money right away, it's even better. You can get involved in their dividend reinvestment program, and that way you can pick up some good shares at some lower prices with no commission. So I think that's a good way to kind of get paid while you wait for the things to turn around.
On that note, Matt, thanks so much. Matt Maley with Miller Tabak. Well, investors got a new batch of economic data today, and let's start out with existing home sales, which unexpectedly rose in November. According to the National Association of Realtors, sales of previously owned homes were up 1.9% from the prior month. But compared to last year, sales are down 7%, which is the largest year-over-year drop since May of 2011. The median sale price in November, however, was more than 4% higher than a year ago, to about $257,000, a rate that outpaces wage growth. And the current account deficit widened to a 10-year high in the third quarter. Exports fell, imports continued to rise. The report, which measures the nation's trade and financial flows with other countries, also showed a 50% decline in companies bringing their foreign earnings back to the U.S. It is time to take a look at some of today's upgrades and downgrades. American Express was downgraded to neutral from buy at Bank of America Merrill Lynch. The analyst says macroeconomic uncertainty will result in weaker sentiment for the stock. The price target is $115. The shares fell 2% to $98.77. Under Armour was downgraded to underweight from neutral at Atlantic Equities. The analyst cites the potential for slower growth. The price target is $14. Shares fell more than 3.5% to $18.10. Best Buy was upgraded to neutral from sell at MoffettNathanson. The analyst there cites a strong holiday season and the stock's valuation after a recent decline. The price target is $52. The shares fell along with the broader market to finish at $50.96. Still ahead, a tie-up that could create a healthcare powerhouse. Johnson & Johnson lost its motion to reverse a jury verdict that awarded billions of dollars to women who blamed their ovarian cancer on asbestos in the company's baby powder. The legal decision comes just days after Reuters reported that J&J knew for decades that cancer-causing asbestos was in its baby powder. J&J calls those claims false. That pushed shares lower in trading today. Pfizer has long been trying to decide what to do with its consumer health business. And today, investors got a surprising answer. Pfizer and GlaxoSmithKline, two of the world's biggest drug companies, are teaming up to create an over-the-counter powerhouse that will dominate the market for everyday drugstore items. Investors had kind of a mixed reaction, sending Pfizer lower and Glaxo higher. Frank Holland has the details.
The makers of Advil and Excedrin announcing a merger that will create the biggest consumer health company in the world. GlaxoSmithKline and Pfizer announced that deal on Wednesday. Combined, the two units generated $12.7 billion in revenue last year.
We're announcing a deal that strengthens two business and creates significant value for shareholders.
This joint venture will sell some of the best-known brands in the segment. GlaxoSmithKline will own 68%, Pfizer the rest. Morningstar investment analyst Damian Conover says this merger will make this new company the industry leader with about 7% of the overall global market.
This new consumer business is going to have such significant scale. We will be number one in pain relief, number one in respiratory, number one in vitamins, minerals and supplements, a leader in over-the-counter skin health, and importantly, we will be a top 1 or 2 player in 10 of the 15 biggest markets in the world, including, by the way, the US.
The CEO of GlaxoSmithKline, Emma Walmsley, emphasized the merger will allow the UK-based drug maker to fund and focus on drug research.
But it also allows us to strengthen on our number one priority, our pharma pipeline, by the incremental cash flows over the next few years, thereby creating two focused UK-based global companies. One, a pharma and vaccines company based on the science of immunology, genetics and new technologies. And then one, this new global leader in consumer healthcare. The
deal is expected to be completed in the second half of 2019. The companies are expected to spin off this joint venture within 3 years. For Nightly Business Report, I'm Frank Holland.
Higher prices helped General Mills, and that's where we begin tonight's market focus. The packaged food company has been charging more for some of its products, and that helped improve its profit margins and offset higher freight costs. General Mills is also working to get rid of older food brands, but it has not specified which ones. The stock rose 5% to $38.55. Winnebago reported better than expected earnings and revenue in the most recent quarter. The company cited higher sales in its North American recreational vehicle business. Winnebago also raised its quarterly dividend. That sent the stock 13% higher to $22.67. Eli Lilly raised its quarterly dividend and issued a stronger than expected profit forecast for the next year. The drug maker cites demand for new medicines and its existing diabetes drug franchise. The stock rose more than 2% to $109.11. Allergan will pull breast implants from the European market. The move follows a mandatory request from regulators. The implants have been linked to a rare form of lymphoma in some women. Analysts say potential liabilities are a concern. As a result, shares were lower by nearly 7% to $136.56. Japan's biggest ever initial public offering made its debut, and it flopped. Softbank shares started trading in Tokyo today. Investors watched it closely, in part because of Softbank's reach into Silicon Valley and around the world. Akiko Fujita is in Tokyo tonight.
Concerns about saturation in the domestic telco market and SoftBank Mobile's exposure to Huawei really dampened the mood for the company's big debut here at the Tokyo Stock Exchange. This was Japan's biggest IPO, and with more than $23 billion raised, it was right up there with the biggest IPO, Alibaba, back in 2014. 90% of the 160 million shares that were allotted set aside for retail investors, those first-time mom and pop buyers who are looking to invest in a national champion like SoftBank. And the indication was that the uptake was strong initially, but SoftBank was hit with a number of negative headlines in the lead up to the IPO. Earlier this month, a software glitch left more than 40 million of SoftBank subscribers without access to mobile data and voice, angering users. And then there was the issue of Huawei's CFO being detained over in Canada. The Japanese government came out after that saying they would no longer be using Chinese telco equipment and encourage private companies here in Japan to do the same. That left SoftBank in a bit of a bind. SoftBank is the only mobile carrier using Huawei equipment. And we did hear from executives at a press conference this afternoon saying that they had invested about 10% in Huawei equipment. They're now looking to switch over their 4G equipment and speaking to suppliers, not just in Europe, but in the US as well. They've put the cost of that at a few hundred million yen. That's going to be a big concern for investors moving forward as well. Now, one of the things that has made this IPO attractive is the big dividend payout, 85%, a 5% yield for shareholders. SoftBank executives have said that they are confident they can deliver on that. But given just how mature this market already is and given the performance of the stock, at least in its initial day, there certainly will be concerns about whether Masayoshi Son can sustain that. For Nightly Business Report, I'm Akiko Fujita in Tokyo.
Coming up, Elon Musk's tunnel vision.
Elon Musk says this tunnel is the key to helping defeat soul-destroying traffic. The light says green, which means it's time to go for a ride through the first Boring Company tunnel.
Prison stocks moved lower after the Senate passed legislation late yesterday that overhauls the criminal justice system. That bill allows some prisoners to win early release to halfway houses or home confinement. But the idea that sentences could be reduced for certain prison inmates sent the shares of two prison operators, Geo Group and Core Civic, lower. Facebook finds itself at the center of yet another privacy controversy. The New York Times reports that the social media company let firms like Netflix and Spotify read members' private messages. In all, the data sharing arrangements benefited more than 150 companies, including Amazon, Yahoo, and Microsoft. In a blog post, Facebook denied it allowed the actions without user consent, but the stock fell 7% in trading today. Elon Musk is at it again. He already set his sights on revolutionizing the auto and the space industries. Now he's targeting traffic congestion. Musk just completed his first high-speed tunnel outside Los Angeles. Phil LeBeau takes us for a ride in Hawthorne, California.
Zipping along at 49 miles per hour, this is Elon Musk's vision of how we could be moving through and under cities in the future, so we are rarely stuck in traffic jams.
Traffic has gone from just 7th level of hell to the 8th level of hell, and it's terrible. So this is I think finally there's something that I think could solve the damn traffic problem.
Musk envisions a network of elevators lowering or raising electric cars into high-speed tunnels running under cities.
This is the entrance to Elon Musk's high-speed loop tunnel. Now this is a modified Model X. They were giving demonstration rides today. Look at these alignment wheels down here on the front. They're attached to the two front wheels on the Model X. They run along track walls inside the tunnel. That keeps the Model X on course.
Deployable tracking wheels would add $200 or $300 to the cost of a car, according to Musk, but they would not change how the cars handle on surface roads. Still, in a country where cities and states struggle to pay for better roads and bridges, do governments want to invest the time and money to dig high-speed tunnels? Chicago wants Musk's Boring Company to build high-speed transit loops between its downtown and O'Hare Airport, but they've yet to break ground. Despite the doubts, Musk believes the promise of high-speed tunnels easing congestion will convince governments they need to go underground.
This system is designed to do over 150 miles an hour through the tunnel. And I mean, wouldn't it be incredible if you could travel around LA, New York, DC, Chicago, Paris, London, anywhere at 150 miles an hour?
A new way to speed ahead and beat the traffic. Phil LeBeau, Nightly Business Report, Hawthorne, California.
And to read more about Elon Musk's high-speed tunnel, you can always head to our website, nbr.com. And finally tonight, the best countries for doing business. Forbes is out with its 13th annual look at the places most hospitable to capital investment. Topping the list for the second straight year, the United Kingdom. The magazine cites its globalized economy and open trade. Sweden moved up 2 notches to second place. Forbes cites its innovation and calls it one of Europe's leading tech startup hubs. Rounding out the top 3 is Hong Kong. Before we go, here's another look at the day on Wall Street. The Dow dropped 351 points to a low for the year. The Nasdaq was down 147. The S&P 500 fell 39. And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you tomorrow.